Now speaking, Laura Alber, President and Chief Executive Officer. Williams-Sonoma Incorporated reported another solid quarter of earnings despite a challenging macro backdrop. The company is the world's largest digital-first, design-led, sustainable home retailer, with in-house design capabilities and a vertically integrated sourcing organization allowing them to deliver high-quality products at the best value to market. Last week, they launched the newest brand, Green Row, which has been internally designed and developed utilizing sustainable materials and manufacturing practices. The company operates a world-class retail business with their stores serving as billboards for their brands, along with a proprietary e-commerce platform making them one of the largest e-commerce players in the U.S. In Q1, they re-platformed Rejuvenation's website, managed their SG&A expense, right-sized their organization, managed their receipts to control inventory levels, improved customer service metrics, and were recognized on Forbes' list of America's best employers for diversity. Their top-line comp ran down 6%, but their two-year comp was 3.5% and their four-year comp, to 2019, was plus 46.5%. Their operating margin was 12.9% with earnings per share of $2.64. Demand softened from negative mid-single digits in Q4 to down 10% in Q1. The Pottery Barn brand ran a minus 0.4% net comp in Q1, but 14% on a two-year basis and 54.4% on a four-year basis. They saw strength in decorating and textiles categories, block print quilts, heritage patchwork quilts, Americana and coastal decorating, in their baby business. The Pottery Barn children's brand ran a minus 3.3% comp in Q1, minus 6.4% on a two-year basis, but positive 29.6% on a four-year basis. The West Elm brand ran a minus 15.8% comp in Q1, minus 3% on a two-year basis, but 51.1% positive on a four-year basis. They are focusing on industry-leading design and value, increasing brand awareness, expanding into product whitespace, and leveraging channel growth opportunities. The Williams-Sonoma brand ran a minus 4.4% comp in Q1, minus 6.7% on a two-year basis, but positive 33.9% on a four-year basis. They are increasing product exclusivity, innovation, relevant content, and full-price selling. Growth initiatives include business-to-business, B2B, expansion into global markets, India, Middle East, Canada, and launching websites for Rejuvenation, Mark, and Graham, and Williams-Sonoma Home later this year. Despite continued uncertainty with the environment and consumer, Williams-Sonoma Incorporated remains confident in their ability to gain market share by inspiring customers with their portfolio of strong brands, building trust with world-class customer service, and generating strong profits. They have a lineup of opportunities that supports their 2023 guidance and remain confident in their long-term guidance and opportunity to furnish their customers everywhere. Now speaking, Jeff Howie, Chief Financial Officer. In this quarter's earnings call, the company reported a solid quarter of earnings, despite softer top-line results and challenging macroeconomic conditions. Net revenues were $1.755 billion, slightly below expectations, while comparable brand revenue growth on the one-year stack came in at minus 6%. But was 3.5% on a two-year stack and 46.5% on a four-year stack against 2019. Demand was minus 10% on a one-year stack but minus 1% on a two-year stack and positive 46.7% on a four-year stack. Gross margin was 38.6%, 520 basis points below last year and 270 basis points higher than 2019's 35.9%, inclusive of 300 basis points in short-term supply chain-related costs and inefficiencies. Occupancy costs were 11.5%, 170 basis points above last year, while SG&A rate was 25.7%, 320 basis points lower than 2019's 28.9%. Operating income was $226 million and operating margin 12.9%, well down 420 basis points below last year but 590 basis points above 2019's 7%. Diluted earnings per share was $2.64, 86 cents, or 25% below last year's record first quarter earnings per share of $3.50 but significantly above 2019's earnings per share of 81 cents. Cash balance was $297 million with no debt outstanding and merchandise inventories were essentially flat year over year, while inventory on hand increased 28% over last year. The company reiterated its fiscal 23 guidance, expecting top-line results to land within their guidance range depending on the 2- and 4-year trends in Q1, while operating margin is expected to land within the guidance. Headwinds are expected in the first half of the year due to year-over-year demand comparisons and last year's high back-order fill, coupled with the declining macro, leading to negative comps and gross margin pressures. In the back half of the year, these headwinds should turn into tailwinds as the top-line comparisons get easier and gross margin pressures become tailwinds that support profitability. The company remains confident in the long-term fundamentals of their business and are committed to outperforming their peers and delivering profitable growth. Telsey Advisory Group analyst Cristina Fernandez inquired, "My question is, what strategies are you employing to ensure the customer is still focused on full-price selling and how does this strategy help create value for them?" Laura Alber replied, "Thanks, Cristina. The customer has become more cautious since Labor Day due to housing and job loss, but they are still spending. Our portfolio of brands, omni-platform, and positioning allows us to compete better than our competition across price points, categories, and aesthetics. We're seeing softness in furniture but strength in high-end electrics and kitchen. We're shifting our focus to easy updates for the home, entertaining, cooking, and gifts. With big retailers like Bed Bath & Beyond leaving the market, we have an opportunity to pick up more market share. Customers are also buying full-price items that help them update their home without making a large purchase." Telsey Advisory Group analyst Cristina Fernandez inquired, "Given the existing environment, what specific merchandising initiatives or market share gains do you believe will allow you to hit your revenue guidance for this year?" Laura Alber replied, "Jeff, could you please provide some clarity on the guidance range?" "Sure, I'd be happy to discuss our approach to the guidance range. We believe that we have been prudent in setting our guidance range based on our current business performance and market conditions. We have taken into account a variety of factors, such as economic uncertainty and competitive pressures, and are confident that this range accurately reflects our expectations for the upcoming quarter." Jeff Howie replied, "Thank you, Laura. We recognize the uncertainty in the macroeconomic environment and consumers have become more cautious. Our Q1 trends point to us being within our guidance range when extrapolated over 2- and 4-year periods. We expect the first half of the year to be difficult, especially on the top line due to higher demand comps from last year and back-quarter fill. However, the back half should bring tailwinds as our demand started to decelerate after Labor Day in 2019. We are confident that we are gaining market share at Bed Bath & Beyond, particularly in kitchen electrics and registry for Williams-Sonoma, nursery items from Bye Bye Baby, and dorm essentials for teen. We believe we are well positioned to capture the fractured home furnishings industry with our in-house design, digital-first but not digital-only channel strategy, and strong portfolio of brands." Cohen & Company analyst Max Raklenko inquired, "Given the current environment, what kind of cushion do you think you have in order to meet your top-line guidance for the remainder of the year?" Jeff Howie replied, "Q1 results, when extrapolated over our 2- and 4-year trends, land us squarely in the guidance range. This is supported by market opportunities such as some players who lack the balance sheet to withstand current pressures, which presents an opportunity for us to gain market share." Cohen & Company analyst Max Raklenko inquired, "Could you please provide an update on product margins for the first quarter, relative to last year and pre-pandemic, and how should we expect them to trend throughout the remainder of this fiscal year? What challenges remain from last year that may persist in 2021? Jeff Howie replied, "Our selling margins were down 350 basis points in the quarter, driven by lower merch margins and higher shipping costs. The capitalized costs from higher product costs, ocean freight, detention, and demurrage that flowed through our income statement had a direct impact on our merch margins. On the selling side, we faced additional costs for shipping multiple items to customers. All told, these short-term costs accounted for over 300 basis points of the decline in gross and selling margins. We expect these headwinds to become tailwinds in the back half of 23 and into 24. Cohen & Company analyst Max Raklenko inquired, "Could you provide a comparison between the promotional activity this quarter versus last year and pre-pandemic levels?" Laura Alber replied, "Our stance on running site-wide promotions remains unchanged. We strategically mark down items when we have excess inventory, which occurs approximately every quarter. This Memorial Day, we are offering a promotion to reduce our overstock and maintain an up-to-date inventory. You can expect us to take further markdowns as needed." Morgan Stanley analyst Simeon Gutman inquired, "Good morning, everyone." "Hi, Laura." "Hi, Jeff. Could you please explain the strategy to protect the margin guidance of 14% to 15% in light of a weak consumer environment? Are you relying on cost efficiency and other measures, or is there potential for this guidance to dip below 15% before returning to the long-term range?" Jeff Howie replied, "Good morning, Simeon. Thank you for the question. We are confident in our 14 to 15% operating margin guidance for FY23, which is largely attributed to our cost control measures. This includes managing our employment expenses and advertising costs, which have been leveraged in Q1. Additionally, we have quantified that 300 basis points of our 350 basis point decline in selling margin year-over-year is due to our supply chain costs and efficiencies. Lastly, we took a restructuring charge in Q1 that will add an additional $40 million annually to FY23, providing us with further opportunity to hit our 14 to 15% goal. Our Q1 results provide the building blocks to achieving our 15% operating margin floor, especially when taking into account our occupancy and SG&A leverage versus 2019. Morgan Stanley analyst Simeon Gutman inquired, "Can you provide an insight into the size of your backlog and how it will impact the year ahead?" Jeff Howie replied, "Yes, the backlog is now normalized and no longer a factor in our performance. We have seen it decline since the fourth quarter of last year and it is no longer driving our results." Gordon Haskett Research Advisors analyst Chuck Grom inquired, "What gives you the confidence that the home category won't continue to mean revert over time, given the higher base of sales in comparison to 2019? Laura Alber replied, "Thank you for your question, Chuck. Our industry is highly fragmented and competitive, so companies that can gain market share will be successful. The housing market has improved from a 37% decline last year to 22%, but we're not counting on that as a major factor in our success. What sets us apart is the wide range of products that we offer, from home furnishings to pillows, frames, tablescape, gifts, and more, which appeal to customers at various life stages. Customers are still shopping with us and purchasing newness, exclusivity, and regular price items. We believe these factors ensure continued success in our business." Gordon Haskett Research Advisors analyst Chuck Grom inquired, "My question is, has there been a change in the demand comp trend line since the start of the year, and if so, how has this impacted consumer confidence?" Jeff Howie replied, "On the quarter-to-quarter, and they did on a month-over-month basis. We have seen consistent demand trends over the past 2 years, both quarter-to-quarter and month-over-month. Our customers remain engaged and we are confident in our continued success." Jeff Howie replied, "Yes, we saw a deceleration in 1- and 2-year trends in Q1. However, the 4-year trend remains steady. When we look at these numbers and project them forward, it gives us confidence that our guidance is supported and accurate." Loop Capital Markets analyst Anthony Chukumba inquired, "My question is, how are you positioning Green Row within the furniture market and what is your vision for the long-term potential of this new brand?" Laura Alber replied, "Thank you for bringing up Green Row, Anthony. We are proud to have created a brand that is focused on sustainability from the start. Our assortment of products offer both sustainability and fashion, so you don't have to sacrifice style for eco-friendly choices. The product quality is high, with each item built to last. Additionally, the aesthetic of Green Row is more feminine than our other brands, offering us a unique opportunity to explore new market opportunities while staying true to our commitment to innovation at Williams-Sonoma Incorporated." Loop Capital Markets analyst Anthony Chukumba inquired, "Can you provide an update on the impact of Access Easy Money drying up on smaller DTC brands and what changes you have seen in terms of inbound activity?" Laura Alber replied, "Yes, the market is certainly facing challenges. We're seeing a decrease in advertising spend and lack of innovation from certain players. This presents an opportunity for us as we are better positioned to capitalize on the changing landscape. Most will not be able to keep up with our cutting-edge products and services, so this is an advantage for us." Jeff Howie replied, "I believe our strong balance sheet will give us a competitive advantage and help us gain market share as competitors struggle with financial pressures. This will ensure our long-term success in the marketplace." Evercore IC analyst Oliver Vinnermontel inquired, "Can you provide some color on the difference between B2B and trading revenues during the quarter, and explain what drove the increase in B2B contract sales?" Laura Alber replied, "Just said. Yes, absolutely. We are very pleased with our performance this quarter and the continued traction we have seen in the contract business. Our focus on driving large projects continues to pay off, and we saw record results for our brand standard and annuity programs, which drove growth across all sectors. We also saw increased engagement from the commercial sector, and while trade business has softened in recent months, we are starting to see volume building back in our designer business. We remain confident that our competitive offerings will enable us to take market share even as we focus on growing our contract project pipeline." Jeff Howie replied, "Our recent successes in the last quarter demonstrate our success in B2B. We saw triple-digit growth with Marriott and Starbucks, while also expanding our portfolio of residential developers such as Related, Pulte, and Lennar. We completed office projects for Salesforce, Sands Corporation, and Republic Airways, and furnished departure lounges for Celebrity Cruise in the cruise industry space. Our strategy is paying off in a big way, and we continue to gain market share in this $80 billion fragmented market. Evercore IC analyst Oliver Wintermantel inquired, would the following be an appropriate rephrasing of the question? Given your commentary on contract growth in the mid-double digits, should we continue to expect a recovery from the -7% to 8% for the rest of the year? Jeff Howie replied, our B2B sales are expected to provide an ongoing boost to our quarterly performance. We anticipate that this will be reflected in our comps, and we have taken this into account when forecasting for the quarter. Thank you. Barclays analyst Seth Sigman inquired, can you please clarify if there has been stabilization in demand since Q1 and elaborate on the operational drivers that have been embedded in your sales outlook for this year? Laura Alber replied, sure. As I mentioned, we've seen choppiness since Labor Day, and our outlook for the rest of the year takes into account opportunities by brand and Williams-Sonoma becoming a bigger part of the mix in Q4. What's equally important to us is customer service, which was disrupted during the pandemic and cost us money and credibility with our customers. We have been working hard to improve service levels and on-time delivery and are already seeing significant improvements. This will not only benefit customer satisfaction but also our operating margin. While the top line may be subdued, we are making investments in the long term that will enable us to deliver a very profitable business while others struggle. In the end, you'll see us become one of the strongest players in the industry. Barclays analyst Seth Sigman inquired, what sensitivity do you see in the financial model with regards to top-line pressure, and how much lower could sales flex while still achieving your margin and EPS targets? Laura Alber replied, we delivered higher operating margin than expected in Q1 despite lower sales, due to our disciplined approach to finding efficiencies and cutting costs. Our platform and omni-positioning give us the flexibility to respond to changing conditions, as evidenced by our strong performance during the downturn. We are confident that we will be able to produce even if the top line is more subdued. Needham & Company analyst Anna Andreeva inquired, my question for the executives is, considering the volatility of the market, what are your observations on demand in the second quarter? Are the Memorial Day promotions planned at similar levels to last year? Additionally, can you provide further details on the $40 million in cost reductions and how they will impact the P&L throughout the year? Laura Alber replied, thanks for asking the question. We're only a couple weeks into the quarter, so I wouldn't read too much into it yet. However, we are seeing softer sales in furniture, while outdoor is following a later curve than during the pandemic. On the flip side, our textile decorating, gift-giving and kitchen businesses are performing well. We're confident that we will continue to build on those strengths in the back half of the year, particularly with West Elm introducing more modern assortment in gift-giving and entertaining. Jeff Howie replied, Anna, in Q1 we implemented cost-cutting measures both domestically and internationally which yielded $40 million in savings. Only a small portion of these savings were recognized in this quarter, with the majority being spread out over the next 3 quarters. This has been factored into our guidance and gives us increased confidence in our op margin guidance range of 14% to 15% for 2023. Laura Alber replied, thank you for your question. We are very pleased with our performance thus far this quarter. We have seen substantial growth in our top-line revenue and profitability, which is a testament to the hard work and dedication of our team. We anticipate that this trend will continue as we move forward. We look forward to continuing to serve our customers and shareholders.